The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday, 11th of July. Welcome back, Jeremy. Good to have you here again.
Hi, Gareth. Yeah, good to be here.
So we've passed Trump's deadline for tariffs. He seems to have gone for the taco chickening out rather than going too aggressive on that.
Yep.
Let things slide for another few weeks. Be interested to get your views on that and more generally how you think things are going at the macro level.
Well, we began this week rebounding from the strong US jobs report of the previous week, which pretty much dashed all hope of an early US rate cut. And then, as you say, we moved sort of full pelt into the July the 9th deadline for the imposition of tariffs. And as you say, widely expected and derided taco moment sort of was effective as the imposition of these tariffs seems to have been pushed out to August the 1st, which has given risk on asset markets more time on the dance floor. And they've been dancing.
They have in some way, yeah.
But I think that sort of on the broader point is that we're now starting to see a different version of Donald Trump. And I think there are some interesting parallels to our own leader, Keir Starmer, in that they're both being troubled by their bases. So Keir has had notable trouble with his parliamentary base in the House of Commons, which has boxed him in. And in a similar way, Trump has started now to be openly questioned by his MAGA faithful over such things as his intervention in Iran, risking another forever war, becoming friendlier to Zelensky and backing Ukraine, and hardening his line against Putin, and domestically softening his stance on migrant deportation. And probably the headline grabber for his MAGA base is the attempt to close down the Epstein files for future debate, which has really infuriated the conspiracy theorists out there. So the difference between Trump and Starmer is that Trump has now become emboldened by the passing of his major piece of legislation, the BBB, and now has come out swinging, basically. He feels he needs to offer some red meat to his MAGA base. So the way he's come out swinging is to impose fresh sanctions on Brazil, which took people by surprise, I would say. I think it's an overtly political move to protect his ally, Bolsonaro, but also, unfortunately, going to make your flat white even more expensive when you go into town. And he's also imposed tariffs on copper imports and overnight raised his baseline tariff level on Canada to 35% and made other pretty unveiled threats to other people who haven't yet signed trade deals that the baseline of tariffs is moving up from this 10%. So, and I think this all plays into the wider economic debate that's now going on within the US and which is going to impact broader financial markets.
It is. It's funny because it's easy to look at the extension of the July 9th deadline as the taco moment. You know, he was chickening out of the actual imposition of the rates that he previously described. But then you're absolutely right. On the one hand, he's letting that slide by 3 weeks or whatever it is. On the other hand, he's coming out with some really quite aggressive and yes, overtly political is right. I mean, what he's done with Brazil, there's not even a sham economic explanation for it. It is purely Bolsonaro driven. So it's those and the Canada new tariffs are really quite aggressive. So it's a strange sort of juxtaposition of running away from the battle on one side, but equally kicking off some new ones on the other.
Yeah. And I think this ties into what's going on in terms of the critical debate between the fiscal and monetary authorities in the state. So we had the FOMC minutes this week, which revealed a pretty divided FOMC, Federal Open Markets Committee, regarding the outlook for rates due to differing views on how tariffs might impact inflation. This adds fuel to the firestorm that's ongoing between Trump and Powell, and with Scott Bessent sort of caught in the middle. There is increasing commentary out there that is beginning to position itself that maybe the markets, and we haven't yet talked about this directly, but as all this has been going on, equity markets and risk assets are moving to new all-time highs. And the traditional commentary around this is that this is the epitome of irrational exuberance. Well, I think some of the more nuanced commentary around this, and I'd point you to Gillian Tett's article in the FT today, is actually allowing for an explanation that the people who don't want this to work are refusing to acknowledge could be a way forward. It's a narrow path, but there is a pathway that's emerging here, which could actually square this circle. And there is a version of the future that tariffs are not inflationary, that the BBB delivers economic growth. And Gillian Tett refers to the fact that the GDP now measure produced by the Atlanta Fed is showing a growth figure for the US economy at 2.6%, so a very sharp rebound on what was reported in the first quarter, and a bond market that might not be quite at the level that Bessent needs to term out his $9 trillion worth of debt, but it's certainly not out of control in the sense that he's got no chance of doing it. So I think there is evidence that they will be able to hold this together. And while the dollar could still weaken, while we get increased inflationary pressure in the economy that is expressing itself via monetary expansion and growing liquidity and monetary debasement, i.e. positive things like gold and Bitcoin, the actual Trump-Bessent plan here is definitely not dead and buried. I'm not saying it's the base case, but there is a way of rationalizing what is going on here. And I think there's evidence that people are beginning to accept that this could actually happen.
Yeah, it would be incredible. And Atlanta Fed, which is, just for people that don't know, that's the most sort of up-to-date, rapidly produced measure of GDP growth. If they're saying that this US economy is powering on, despite everything that's being thrown at it, all the worries about confidence, all of the concerns about inflation from the tariffs on inbound goods into the States, despite all of that, if the US economy is still growing strongly with interest rates where they are, then yeah, maybe they will pull it off and Trump can deliver the tariff revenue that he wants without causing too much economic shock to the domestic market.
Yeah, and I think that one could rationalize what he's doing now this week on raising the temperature again on tariffs is growing confidence that the tariffs that he's imposed so far are raising more revenue than anyone expected without disturbing inflationary pressures in the economy. Now, we don't know whether that's the case yet. It's too early to tell. But I suspect they feel, or Trump feels at least, that this could possibly be his new magic money tree, raising extra revenue, growing the economy. And even if you accept that debt is not under control, if they can grow debt more slowly than GDP, well, that's better than allowing debt to swallow the economy and sink the bond market.
Yeah.
Paul Tudor Jones's comment that I think defines the financial year 2025, all roads lead to inflation. Whatever happens in almost any macroeconomic circumstance, someone has to be very guarded about being too definitive about this, but it does feel like all roads lead to inflation. Yeah. How does that relate to equity markets? Well, I guess the headline there is that Nvidia is now the world's first $4 trillion company. This is one fabulous semiconductor company.
It's an amazing number. Yeah, it really is. And yes, the equity markets are shrugging off many of these concerns. So see how those things evolve.
So Yeah. What about you? What have you been looking at this week?
So yeah, it's been a pretty quiet week again as we're sort of heading into the summer in terms of the UK small mid-cap market. On the progressive client base, we just had one material piece of news, which was the Scottish house builder Springfield Properties. They gave us a trading update for their year to May, just finished. And overall, the update was in line, so trading nicely and in line with expectations. The real story there, though, is that they've managed to pay down their debt. They brought down their year-end debt from expectations of 33 million to 21 million. So that was driven largely by an early receipt of a payment from Barratt relating to a transaction between the two businesses. So nicely on target in terms of current trading, but a nice boost in terms of better working capital and a stronger balance sheet than expected. So good news from Springfield. But that also made me think a little bit about another company I've been looking at recently, Lords Group Trading, which I think you know a little bit about.
Yeah.
It's a business which is involved in plumbing and heating supplies and installations and general merchanting into the building trade. It's not a super well-known stock across most investors in the London market, but I think it's an interesting business. And what reminded me of that, given the Springfield situation, was that towards the back end of last year, I think it was, Lords Group did a quite significant sale and leaseback of a number of their depots and their property assets. And they got that capital in, which they were planning to deploy, still are planning to deploy, to make them more agile for tactical or sort of strategic acquisitions and M&A. They've been quite acquisitive in the past, and I think they're planning to continue that as the market's been under pressure. And then they had a very opportunistic deal. They picked up the assets of CMO, the old construction materials online business that a number of investors will have been aware of. They bought that out of insolvency. So they've already put a small amount of that capital to work. And the market's responded very, very strongly. I mean, I think perhaps as investors are looking at the way they're shepherding capital and looking at the way that they're pivoting that capital from a slightly stuck, potentially low return situation as a depot or a warehouse or whatever, and saying, actually, we can release money from those locations and make it available to allow us to speed up our acquisition of potentially troubled competitors and really grow the business quite quickly. So the market is saying, yes, actually, we back you to do this. We think that is a good stewardship of investors' capital. And there's maybe a broader point, which is that in a world where interest rates might remain for a while, if interest rates are going to stay there and return on capital needs to be at a decent level, those companies who are good at managing return on capital, think about it carefully, manage their investors' funds in an intelligent sort of academic way, applying capital where they can get the best returns, those companies will do well.
Absolutely. Well, I'm going to have another look at Lords, I think. That's interesting. Yeah.
And what about over the next week or two? What's in the diary coming up?
We've got coming up quite a busy week ahead of us. On Tuesday, we get GDP and other data, such as industrial output and manufacturing data from China, where commentators, I think, will be looking for signs of any tariff impacts on the economy there, and also for signs or hopes of growth in domestic consumer spending. So, yeah, obviously always quite a lot of skepticism around quality, integrity of data coming out of China. But I think that's going to be the focus for Tuesday, followed later that day by inflation data from the US, with obvious implications for the developing turf war between Trump and Powell, which we spoke about earlier, given the growing debate about the impact of tariffs on measured inflation. But yeah, it looks like the inflation data is expected to show a small tick up in measured inflation. And Wednesday, we see inflation data for the UK, which again is expected to show a marginal upwards move. And both the US and the UK will continue to see measures of inflation comfortably ahead of the target 2%. So work to be done. Then followed on Thursday, we get employment data from the UK. So looks like the measured unemployment rate for the UK is going to be pretty flat, but could be a risk point there. And on Friday, we get inflation data from Japan, which is going to show us the highest rate of inflation of all the developed world at over 3.5%. And as we've spoken about for the last few weeks, no one's going to care. But I think going forward, I think it's all going to be about the rumpus between the Trump administration and the Fed.
Mm-hmm. Okay, lots of inflation stuff next week to look forward to and see what's happening in terms of some of those big economies. But great catching up as ever, Jeremy, and look forward to speaking this time next week.
Okay, look forward to it.
Talk to you then.
Brought to you by Progressive Equity.